afternoon, everyone, and happy Friday. It's Alyssa Corman, Ed Carson here with a look at the stock market today and a look at how the week unfolded as well. We're going to be taking a look at the major indexes and also checking in on the charts of ASML, Ford, and Teck Resources. That's TECK. So Ed, if you could go ahead and pull up Thinkorswim, we are going to be taking a look here at the S&P 500. So we saw some nice support for the S&P and Dow this week, but the Nasdaq is hitting a resistance level.
Yeah, I mean, bottom line is that we're still in a stock market rally that is under pressure. It is that the market rally is there, but it's not thriving, but it's not dead either. As you said, the S&P and the Dow basically undercutting their 50-day lines, which also sort of coincides with this half standard deviation line situation where it came down. It actually came in just avoided going underneath this low from about a week earlier, rebounded. That's nice. And then it, came back a little bit down today, like on the S&P. So faded a little bit. So this was relatively positive. Honestly, we're very close to the 50-day, but we're also very close to an all-time high. The S&P is trading in a fairly narrow range, not acting too badly. It was very good to see that support.
And we now have these regression channel lines for the S&P. So this is a little new. We had been focusing on that for the Nasdaq, but if you're watching IBD Live, you've seen these regression lines for the S&P, and right now it's looking pretty good here for the S&P. But if we flip on over to the Nasdaq, the audience can see why we've been focusing more on the S&P with the Nasdaq below the lower regression channel lines for a while now. And even though it midweek saw some nice gains, resistance at its 50-day line.
Yeah, there's a lot of things in here. This is one reason why we talk about not buying right at the open. The market had a nice open and then very quickly started struggling, and then most of the afternoon was below break even and really closed sort of poorly. It was not a great close. I mean, ultimately, it wouldn't take much for this market to get back on its feet, but it wouldn't take much for it to get to its knees. And it's just sort of like, it's just really tricky. And it's just so difficult because the temptation is to buy when things are going up, and then things roll over either the market or the sector or the stock. And it's just tricky to try to deal with that kind of situation.
That's exactly right. It is. And so the caution or suspicion is still warranted here, even though we are in rally mode. It's just not the time to be getting aggressive at this moment.
Yeah, that's right. And there's different sectors. I mean, we saw miners and retailers, for some reason, a lot of them came under pressure. Some techs came back, financials did okay, but it's hard to get that edge. It's just hard to know what's working, what's not, what should I be doing? And in that situation, it's reasons why you don't want to be too aggressive. And we'll get into that, I guess, a little bit later on.
Yeah, because it's the miners and retailers. Those are among stocks that have been working well, as tech has, as we've been pointing out a lot, has largely been lagging. So yeah, underneath the surface, still a very tricky environment. And we're going to take a look at the Nasdaq weekly chart here now as well, just to provide the perspective of how we finished for the week here. So there's your big view. Now zooming in. So what does this candle here tell us, Ed?
We did decline, and it's blue because of the way it sort of finished up, but it's like we ended up declining a little bit, I believe, for the week, and it's just just sort of trending lower here, and we did finish off the lows, which is nice. We finished off the lows for 3 straight weeks, but ultimately we're sort of trending lower. I mean, it's nice to finish better than it's better than the alternative, but you do also step back and say, well, what's the broader trend beyond this week? And the trend is, since we got up here and got up to record highs, it's been just falling off since then.
That's right. So it would be really great to see the Nasdaq back above the 50-day or on the weekly chart, the 10-week line. So a key level there that we are continuing to watch. But it could have been worse. At least we did see a little boost of buying there in the middle of the week, but we're going to keep a very close watch on these levels for the Nasdaq to see if this split market can resolve itself. But one area that we do want to take a closer look at is the chip sector through the chart of ASML, Ed. So if you could pull that up as well, let's take a look here. So ASML was able to find support at its 50-day line this week. What do you think that the action in the chip sector tells us about the health of this uptrend?
Yeah, I mean, it's right there on the edge. And it's like maybe a little bit more on the positive side, but it's sort of like just on the other side of that 50-day line. I mean, chips keep on flirting with being leaders. And ASML is one of the leaders within that chip sector. It tested support at the 50-day line, has done that a couple of times, never really broke below it like some did, quickly got back above. You could argue that it's sort of above a trend line or sort of got above a trend line right there. So it's right on the edge of an early entry. You could buy it off the 50-day or 10-week line. You could buy it off the trend line. At the same time, it's not screaming out, please buy me. It's like, it's one of those things that if you did want to get into it, just like anything else, it'd be like tiptoeing into it because you don't know. We could easily just see it come right back down. Every time we've seen the stock come up, it's had trouble making progress. Of course, that's nothing really unusual in the chip sector or just in general with the market in the last few weeks.
So if we do, though, start seeing breakouts from a number of these chip equipment and chip stocks or breakdowns, a lot of them starting to live below their 50-day lines, does it seem like that would have an impact on the technology landscape and what the Nasdaq's doing? Do you think that could provide any clues for us?
Yeah, I think absolutely. I mean, chips are in everything. I mean, it's sort of like, and it's not just chips. Obviously, we know they're in autos as well, as we've certainly learned that over the last few weeks, how much chips are in there. So and just the size of it and all the companies that need it, when you think about just the market cap alone of chips and chip related companies, just that movement alone will move the Nasdaq. And then you just think about what it does be saying about demand, about trends in investing. So, I mean, if the chips can do well, it's very likely that the Nasdaq will do well. But on the flip side, it could be the other way around. If the Nasdaq slumps as it did today, you're not going to. It's very hard for the chips to make a lot of progress.
Exactly. And let's also take a look at the Dow. So how blue chips did for the week. So similar action here to the S&P.
Yeah, and I pulled up the diamonds just so people can see the real time, just to, instead of delay. Yeah, this one actually closed a little higher because it doesn't have quite as much tech as, say, the S&P. But it rebounded from the 50-day line. Actually, did undercut a little bit, but not a big deal. Closed above the 21-day line, like the S&P 500. So not far from a record high, not far from a test of the 50-day line again. So this looks relatively healthy. We've said this before. If the Dow and S&P were all there was, we wouldn't be under pressure. We'd be saying, this is fine. A little pullback, no big deal. So it's nice to be above the 21-day.
And small caps, the Russell 2000, which we're going to take a look at the IWM ETF, hitting resistance a couple times at its 50-day line this week. So not in the healthiest position.
Yeah, and you can also see how the relative strength line is weakened. A few, back here, this was really leading along with, something, and this is now fading off quite a bit, and it's gone on for a while, and it's becoming more and more noticeable. This getting above the 50-day line, the Nasdaq getting above the 50-day line, even if they don't lead, if they can just sort of get out of this sort of like resistance area, would really, really positive. I do want to caution that just getting a little bit above, whether it's the Russell or the Nasdaq, that's not the end all. We've done that plenty of times. Yeah, that's one barrier, but then you really wanted to see that continue. So, that would be one step, but you'd really want to see it break through and keep on showing some real strength.
Exactly, because if you look at last fall, October, November through January, that was a very different period in the market. So that kind of trend, that trending market, power trend, we like to talk about, especially for the Nasdaq, it's those kinds of markets that you really have the wind at your back, not just a retaking of the 50-day line. It's really seeing that trending market.
Yeah, absolutely.
And now let's take a look at Ford. You mentioned chips going into automotive, but Ford having a very strong week. I think that the action for Ford was before this week was actually a little bit disappointing, because we were saying that for position traders who bought that breakout towards the beginning of the year, a number of weeks back, Ford did have a decisive close below its 10-week line after the earnings report. So that does mark a sell signal for position traders, but Ford revving back up this week in a big way.
Yeah, it was really surprising. And they came out and there's still those challenges. They came out and said, hey, production's going to be half of what it normally is, in Q2, or half of what it could be because of the chip shortage. I mean, everybody's facing that issue, but Ford really seems to be having an issue. So did not respond well. And sometimes you have to get out of a trade and then it bounces back. And that's just the way it works. It came out on Wednesday night and said, hey, we're going to come out with an electric truck. It's the EV version of the best-selling F-150, and it's going to start for less than $40,000 before federal tax credits. And I think that caught a lot of people's eyes. It's like, oh, they're going to sell a lot of these, so whether, we'll have to see. That's not going to come out until probably like late spring 2022. So another year from now. They're already getting a lot of reservations, but that, when you have the Mach-E, they're coming out with some other stuff. It's for right now, that trend is really working for it. It broke above this trend line on Thursday. You could have bought it here. And then you probably could have bought it Friday morning. It was still by the trend line, by the 50-day line. Now it seems like it's getting up there a little bit, but there was certainly an entry this week off of that.
Right. And for those who are new to chart reading, might think, oh, well, it's still approaching a buy point there above the 1362 level. But with the big move that it's had this week, and now the space that it has above its 50-day line, it seems like at this point, we'd want it to set up with some sort of handle or tight action to present a new proper entry. Because at this point, with the strong move, seems like you might be a little bit vulnerable to a pullback if you initiate it around these levels.
Yeah, there's always that risk when you go out straight up from the bottom. But when you consider that we're in an uptrend under pressure with sector rotation, I mean, it almost seems like you are really, if it gets up to here, races up without a pause, it just seems like the odds are very high of a pullback. Doesn't mean it would happen. It doesn't mean the pullback would be very bad. It doesn't mean that. It just, it's just one more factor to consider. It'd be great if it could pull back a little bit, pause, consolidate a little bit, and then move out. But, we'll just have to see. The stocks in the market haven't really done everything we'd like to in the past few months.
Of course. Yeah, but you're right. The chances of it are there. And so speaking of a breakout that can round trip or pull back, let's take a look at Teck Resources, ticker TECK. So not all too long ago, this stock was looking pretty hot. May 5th, powering above a 2292 level and running up from there, but it's now round trip those gains, Ed.
Yeah, whether you use this or you use this entry, it broke out on May 5th, kept on running up. So it's looking great, relative strength line, which wasn't immediately there, it was picking up. But commodity prices, copper prices came back down. I mean, it's just, and that's an issue with commodity stocks, really sold off. And you say round tripped, whatever buy point you use. And at that point, you really want to get out. You don't want to see a 10% plus gain turn into a loss. And that's what was happening by either buy point. This was really a pretty big gain from this point to here. And to see all of that, that's really discouraging. And that's just the kind of market it is. It is also a lesson. This was one of the later ones to break out. It did have a really good start, but you have to have a game plan in place and make sure that you don't freeze and make sure that you take action so you don't take a sizable gain and let it turn into a loss.
That's right. So speaking of game plan, does it mean that in this kind of scenario, ideally, in hindsight, taking some profits into strength, even though we typically say take profits at 20 to 25%, but given the choppy market waters, maybe taking a little bit off the table when you have a 5 or 10% gain, does it seem like that might be a compelling idea?
It also, I think it depends on what your philosophy is. It can be tough. I mean, you should need to adapt a little bit to this market. One, you probably don't want to be buying too much, but you can do that, or you can just make sure you have, keep your positions small and you can sort of hope to try to do it, and maybe even you'll accept it, come back all the way to your buy point, you know, in that situation, and then you sell. But have a strategy. You know, think about what you want to do here. There's a very good chance these breakouts are going to fail in this kind of environment. You have to keep that. You have to be just aware this is a different kind of environment. The gains are going to be smaller. The breakouts are more likely to fail. Taking the loss, taking profits quickly, either partially or full, is a very valid strategy. You can also just try to take a small position, and if you can hold that gain and just sort of hope it can just sort of gradually go up, that's another way to go. But you have to be flexible, and you have to follow sell rules pretty aggressively.
Most definitely. Well, let's follow up this discussion on strategy with the talk about exposure at this level. What do you think is the way to go in terms of market exposure? Because it has been tricky. Breakouts have not all worked, and there's a lot of rotation still happening underneath the surface, even though there are a lot of bright spots and a lot of stocks, you know, that we can point to that have gone on these fantastic moves over the last couple of months. But there's plenty more examples of trades, I think, that maybe have just been short-lived or haven't worked out in the position trader way.
Yeah, I mean, I would say you would want to have your exposure be fairly modest, and that exposure should generally be weighted toward things that, for whatever reason, the last couple of months those trades have worked, or you had them for a long time. You probably shouldn't be thinking, I want to get a lot of new exposure right now. You know, in a good uptrend, like that uptrend you were talking about with some of these things, these long uptrending markets, you know, most trades are going to work. I mean, most stocks will rise. So if you buy them, your odds, chances are, hopefully you get more than 50-50 will win. If you keep your losses small, you have some decent winners, you have some big winners, all of a sudden you have a really good portfolio gain in that kind of environment. In this environment, you know, less than 50-50 seems the way it's going. Your losses can be pretty big. The gains are small. So all of that just, you know, the odds are just not really in your favor that the portfolio is going to go up. So limited exposure, probably not many new buys, you know, and, you know, if you're entirely on the sidelines, that's okay. You know, that's not terrible as long as you're paying attention to the market. You know, if you can preserve your capital and be ready, there'll be another uptrend. There'll be another uptrend, and then then there'll be easier gains. But I think that's generally how people should be treating it, keeping the exposure light, not really trying to add in until we get that decisive moving up that we haven't had for a while.
And we don't know when that's going to come. The environment can change very quickly, which is why it's important, as you said, if you're on the sidelines, especially, to watch, to be at the ready. And so that way you're not late to the party whenever we do see a significant change in the tone. We're always optimistic and looking for that next opportunity. And we don't know. It could be right around the corner. We'll have to see.
I mean, it's a little bit like we talk about the sidelines, but it's not like a football season where it's off season. You don't really have to pay attention. The game is always going on. It's just that sometimes the game's not in your favor. So yes, it can happen any moment, especially in this kind of environment. So yeah, pay attention, because then you can get the watch lists going. And so you'll know which ones, and that has to be consistently updated, because with the sector rotation, the stocks that looked good a couple of weeks ago, and maybe they don't. And you have to just keep on doing that. So when the market really does turn around, you're ready to go with some stocks that may be the real leaders, instead of waiting, that week or two, and all of a sudden the good ones are out. So, you know, that's, you know, you just want to be taking it, stay engaged in this time. Don't get too exposed, but stay engaged.
Right. And so keeping your eye on the prize, which is that next trending market, do you think that that's, you know, the positive attitude that maybe some investors who, you know, the morale isn't quite great because they've gotten nicked here and there, you know, how do you stay focused on that next opportunity?
Well, obviously it's a little different for you and I, because we're always focused on the market, it helps. But, you know, I think this is where actually trying to be less exposed can help, because at some point you can just become mentally exhausted and just say, like, gun shy from taking a bunch of losses, and then it'll make you not want to get in. It's just like, I've been hurt too many times, I don't want to go in anymore. It's like, so you want to just keep it relatively light in this situation, And I think that way it's easier. You can stay more positive because if the market goes up or down and you're not really exposed or you're out entirely, it's easier for you to just like, oh, okay, that's fine. That's fine. I see some interesting things going on. I'll be ready. If you're just constantly getting hit, it's hard to be thinking, oh yeah, tomorrow will be bright. It's just like, oh, I just want this to be over. I'm just so done. I want to get away. So I think actually being less exposed can help you to keep that positive mindset.
Exactly. And if you are, be very selective. Don't buy extended. Go in perhaps with smaller position sizes, all the things that we've been talking about. But anyway, thanks for all that, Ed. And thank you all for tuning in. We will see you on Monday. Hope everyone has a great weekend.